Okay, Bismillahirrahmanirrahim. Next, I'm going to explain to you about the transaction cost theory. So, different institutional or organizational arrangements exist principally for the purpose of facilitating transactions. That is, reducing cost of conducting a particular activity or production. So, when you talk about the cost, you want to minimize your cost. You want to reduce your cost. Okay. So, and then transaction costs are divided into pre and post transaction costs, to ensure that interests of the parties involved are protected. So you have the pre-transaction cost and you have the post-transaction cost. So pre-transaction cost means before. So the cost that a firm incurred before transacting with other economic actors, that are the other firms or employees of the firm, the economic actors. So which involve with legal contractual relationship. Whereas your post-transaction costs, that are the companies have to incur post-agreement costs to maintain such agreements, such as monitoring and administrating costs. So if you see here, you just Google it. Transaction cost theory is part of corporate governance and agency theory. We already look into your agency theory and corporate governance. So it is based on the principle that costs will arise when you get, okay, it is based on the principle that costs will arise when you get someone else to do something for you. That, for example, the directors to run the business you own. So, why do you have this transaction cost? Because normally it arises because you are as the principal or the shareholders. You hire someone. So you appoint someone else to manage the business for you. So, for example, you appoint the directors to run the business for you. Okay, so transaction cost theory is an alternative variant of the agency understanding of governance assumptions. So it describes governance framework as being based on the net effect of internal and external transactions. Previously, we have used the words pre and post. So it's either the internal or external transactions rather than as contractual relationship outside the firm. So you are looking at the internal and external transactions. Here you have the external transactions, your types of costs, you have the what are the costs associated with the external transactions. You want to search for information. If you want to search for information, you have to incur costs. So search and information costs to find the supplier. You have the bargaining and decision. So bargaining and decision to purchase the component, you have to search for information. So that is also the cost. Policing and enforcement cost to monitor the quality. So that is the cost. So the way in which a company is organized can determine its control over transactions and hence its cost. So you look at the transactions and that become the cost. It is in the interest of management to internalize transactions as much as possible. Okay, to remove these costs and the resulting risks and uncertainties about prices and quality. Okay, so you will have this transaction cost. Okay, and then you will have the internal or external cost, or the pre-transaction cost and the external transaction, the pre and post, or internal and external. Okay, so that is basically what your transaction cost theory is all about. Okay, with that, I thank you.